Good morning, everybody. Absolutely delighted to see so many people have joined this morning, and it's so sunny. I guess we should all be outside. But anyway, it's all about the money this morning. And just to let you know that this session will be recorded and will be posted in the ASSC members area in the next day or so. So if you miss anything, don't worry, you can watch it again. And also, if you've got any questions, please put them in the chat area and we'll have a Q&A session a little bit later. And anything we don't cover in the Q&A, we will publish later on. So don't worry again. And if you've got any further questions after the event, just let us know, send us an email and we can look into getting a response to you. I'm absolutely delighted to be joined this morning by Jess Kelso, who is Director of Customer Experience EMEA at Beyond Pricing. She's going to talk to us about the importance of pricing structures. As you'll know, Scotland's strategic framework leaves a little bit to be desired in terms of clarity. However, Jess is going to help us to prepare for reopening and suggest what we can do today so that we're ready for tomorrow. Jess, as I've said, leads customer experience at Beyond Pricing, and she brings a unique perspective, not only as an industry insider, but also as a member of the small team that grew Beyond Pricing from a single room office in San Francisco to where it is today. She's currently in Portugal, which sounds amazing. Anyway, Jess, welcome this morning and over to you.
Thank you so much, Fiona. I really appreciate it. I'm really excited to be here. I'm just going to go ahead and share my screen. Great. Pardon me. So first of all, as Fiona mentioned, my name is Jess. I'm the Director of Customer Experience for EMEA for Beyond Pricing. I am an Australian who has spent the last 10 years in San Francisco. So please excuse my accent as it dips in and out of random influences from the last several years. But I've been with Beyond Pricing for several years now at this point too. And my focus has always been on the customer and the product. And I'm really excited to bring that knowledge and experience here to work with our customers in Europe. And so today I want to tell you a little bit about Beyond Pricing, but more importantly, share some of the data and the trends that we're seeing in the Scottish market. And as Fiona alluded to, like what we can actually do with that data to make sure that as property managers, we're preparing for the rebound and the recovery. So first of all, I just want to talk a little bit about dynamic pricing and what we do at Beyond Pricing. So we specialize in dynamic pricing, which is essentially changing the price based on changes in supply and demand that we're seeing in the market. So in regular times, you might experience this booking a flight, for example, like a flight on a Tuesday at 2 p.m. is usually cheaper than a flight on a Friday night at 5 p.m. So the same thing happens with short lets. And many of you probably already have some sort of variable pricing, like weekday and weekend prices or high season and low season prices. And the cool thing about Beyond Pricing is we will automate all of that for you. So another value add we have is that we're in a unique position because we're looking at the data trends to deal with the unexpected. So we do look at historical trends, but we also look at forward-facing trends to see what we're seeing in the market, and we can automatically adjust your price accordingly. So dealing with the unexpected is also an area where we help. And basically, we help property managers generate more revenue by increasing pricing for high demand dates, such as a bank holiday weekend, for example, and then also increasing occupancy during low demand dates. So in that shoulder or low season when it can be more difficult to get bookings. Beyond Pricing is a really clean and functional tool that gives you a really easy and quick way to adjust your rates. We also have the largest data science and revenue management team in the industry, which is important always, but especially now as we look to understand how demand trends are aligning with previous years, but also deviating from previous years and what that will mean for occupancy going forward. Our revenue management team hand launch each hyperlocal market to ensure that the pricing adjusts automatically based on what's happening in your local area, which gives the most accurate pricing. We're also more than just pricing. We collect a lot of data to inform the algorithm, and our revenue management team use a lot of different reports and information to make their decisions. And so we surface all of that in Beyond Pricing for you to use as an individual too. So we look at information on an individual property level, through to a portfolio level if you have several properties, through to the market level. And then you can see how each of them stack up at each level. And then finally, we live and breathe for our customers. We have a world-class support team that's global, it's available 24 hours, and we're always here and willing to help. So I just want to take a quick look at what dynamic pricing looks like in practice with Beyond Pricing. So here is a screenshot from my calendar from my listing near Loch Ness for this upcoming June. So you can see here that we start with a base price, and the base price is essentially the average price throughout the year. And so then what you can see here, to arrive at our suggested price for the day, we layer on the factors that have the largest impact on pricing. So seasonality, we're increasing rates because it's high season. It's summer holidays, so we're also increasing the rates. It's a Saturday, this date that I'm looking at, so we're also increasing the rates. And then we're seeing this pent-up demand from people not being able to travel much in the last year. And so we're also increasing rates additionally for that. And I wanted to share this with you because even if you aren't using Beyond Pricing or you don't want to use Beyond Pricing, I think this is a great way to think about pricing your listings. I'm sure many of you are already using a variety of seasons, as I mentioned before, for like high and low season, weekdays and weekends. But I think here, I really want to highlight, it's not about price gouging, but we like to call it responsibly raising rates in line with the shift in demand that we're seeing for short lets this year. So on that note, let's jump in and take a look at some of the data. So here we are looking at sorry, I'm just going to move everyone out of the way. Here we are looking at the bookings made each week in Scotland in 2019. So the number 1 here refers to January 1st through January 7th, and 52 here refers to bookings made between December 25th and December 31st in 2019. So what we see here is a pretty average chart. This is for Scotland, but this is what we see kind of around the world. We see a slight uptick at the beginning here with people planning their holidays for the year. And then it kind of stays pretty average with people booking week in, week out. And then it sort of tapers off as we get into Christmas and kind of people are focused on celebrating the holidays with their family rather than booking holidays in the future. So this is pretty standard around the world. So that's what we saw in 2019. So if we take a look at what we saw in 2020, we saw a really big shift. So, we had a slow first week, but it sort of followed the trend that we'd seen in 2019. And then all of a sudden it starts to drop. And so here we're entering, week 8 of the year. So we're in February. And so this is when kind of the news of COVID and what that would mean for the world and Scotland in particular was coming to bear. And so here we can see the number of bookings that are being made drop significantly. And then by the time we hit March and April, there are hardly any bookings being made at all. There was too much uncertainty as to what the future would look like. As we were coming out of that lockdown, we actually saw a huge increase in bookings, far more than in 2019, for example, as people got excited about potentially traveling again. But I don't need to tell you that a lot of those bookings ended up in cancellations, unfortunately. But this is what we're seeing here is this increase in bookings of this pent-up demand. And then as we get ready to face more lockdowns in the future, you can see that the bookings start to decrease again. So 2020 was really up and down and kind of all over the shop. And interestingly, this is what we're seeing in 2021. So this kind of isn't like any demand trend we've seen anywhere else. Here we can see, in this week in particular, week 8, we've seen twice the volume of bookings than we saw even in 2019, which was a good or a regular year. So we saw that bookings started off slowly, and then as news of vaccinations and, you know, potential paths to reopening and roads to recovery were released, we saw people really start to book in numbers like they haven't done before. So what does this mean for you? For most of you, I'm sure it means you've been really flat out, especially over the last 3 weeks, which is probably a lot after the last year we've had as well. So I know you've all been busy, but what I want to do is encourage you to take stock of your remaining inventory and make sure that it is priced in line with current demand trends. So I want to go back to that idea of responsibly raising rates. It's not price gouging, but what we're seeing here is a huge increase in bookings. So what this means is that compared to previous years, there are far less properties available now to book for the rest of the year. So there are a lot of people who booked in the last few weeks, but there are a lot of people like me, for example, who I definitely plan on going on holidays in the summertime, but I want to wait to see if I can get vaccinated or sort of what this looks like before I decide where to go. So I'll still be looking to book a holiday sometime in June. And when it comes time for me to book a holiday, a lot of these have already been booked because we've seen this increase in bookings. So I'll be willing to pay more because there'll be less inventory. So the idea here is take stock of what you currently have left and make sure that the rates are raised responsibly to reflect the change in demand we're seeing in the market this year. So that's great. We looked there at bookings when they came in, but now we want to look at when people are booking to stay for. So if we look at this chart here, what this is showing is in the last 3 weeks, so late February and the first 2 weeks of March, when were people booking to stay? So in late February and the first couple of weeks of March, 2 years ago, so in 2019, people were booking then to stay in March and April. So people were making bookings to stay in the immediate short term. And then you can see there are some bookings too for May, June, July, August, but in general, people were booking to stay sort of within the next 6 months rather than planning for far out into the future. And this is a bit more common than you think too. Often there are people who plan far in advance, but there are a lot of people who plan fairly last minute to go on holidays. So if we take a look at the bookings that came in late February, early March, 2020, we can see that this shifts dramatically. So we can see that more than 50% of the bookings that came in March were to check in March. And so this makes sense, right? It's a combination of people trying to get one last holiday in before lockdown or booking a longer term stay in a rural and remote location to wait out the lockdown. So let's take a look at what we're seeing in 2021. So in 2021, we can see no bookings that came in late February and March so far have been to stay in the immediate short term. And instead, we're seeing this spike in the summer here. So people are booking to stay, they're booking now, they're planning their summer holidays now. Interestingly too, though, we're also seeing some bookings come in throughout the spring in April and May, and a lot of these are to stay at Easter. So what we're seeing here is that people are hoping and maybe hedging their bets that they might still be able to go away at Easter, but several of these bookings will need to be moved or cancelled. And so this is where I want to talk quickly about cancellations. What does your current cancellation policy look like? How do you handle requests to move a booking? You know, would you move Easter to Easter next year at the same rate? If you were to move an Easter booking to the summertime, would you adjust the rate? And one approach I've seen work really well with our customers is to offer kind of a voucher. So we found that it's a good middle ground. So if you give the guest a voucher for the amount that they've spent on the stays so far, that can be applied to future bookings. So this makes guests happier than a strict cancellation policy because they still get to use that money towards a stay in the future. You can keep the income from that booking in the short term, but then you can also rebook them at this kind of appropriate rate based on the demand that we're seeing in the future. And so make sure that you can, cater to your guest while also not underselling your properties far in advance. So the key takeaway here is just to examine your cancellation policy and make sure that it's working both for you and the guest. And I know there are lots of pros and cons to different approaches here, but this is one that we found that works really well to ensure that guests are happy and prices remain appropriate. The last piece of data I want to jump into here today is actually the length of stay. So what we're looking at here in this funny graph is you can see the months along the bottom here. And each of these sections shows how long people booked to stay for in these timeframes. So this dark blue is stays of a month or longer. This section here is stays of 1 to 4 weeks, so longer short-term stays. Down here in the light blue, we have weekly. And then in the middle here, we have bookings that were for stays of less than 1 week. So what we saw in March, April last year when COVID hit was we saw a significant increase in bookings of 1 to 4 weeks or month-long stays. That makes sense. As I referenced earlier, we saw that uptick in March of people to stay in March, and it was people escaping the city to ride out the lockdown in rural and remote areas usually. And then what we saw between July and December last year was a significant increase in bookings of less than a week. This makes sense too. People couldn't confidently plan week-long holidays like they had in the past. And instead they were just grabbing any opportunity they could get for a change of scenery, maybe a long weekend here or there, and had to work around different restrictions and lockdowns in certain areas. And so then what we've seen here over the last week is you can see this, over the last month, sorry, this spike here in bookings of week-long stays that were made in February directly correlates to the graphs we were looking at earlier, where we saw the increase in bookings in February and the increase in occupancy to stay in the summer months. So this here reflects people returning back to book their traditional holidays. So this is a spike in week-long bookings in the summertime. Now, what I think is really interesting here is we have this spike, but now we're seeing it move back down. So currently in March, the bookings that have been made so far, almost 50% of them are actually to stay for less than 1 week. And I wanted to highlight here was this because what we saw last year was people who had flexible minimum stay requirements throughout July and December, which encompasses high season for a lot of people where we traditionally look for 1 week stays. People who were willing to take stays of less than a week performed better because they were able to cater to a larger segment of people looking to stay in that time. And they also got more exposure for their listing because they were coming up in searches for people looking for both weekly, for any stay basically, weekly, monthly, but any stay less than a week also. So what this means for you now is I really encourage you to examine your current minimum stay requirements and make sure that they are the right combination of, working with your requirements as a business, but also ensuring that your listing is being presented in front of all people who are looking to book. And what we're seeing here is that's a combination of people who want to stay for a week, but also a lot of people who want to stay for less than a week. So in summary, to get ready for the rebound, I encourage you to check your summer prices and make sure they're on the higher side and in line with what you're comfortable with. As I mentioned, there's still lots of time between now and summer for people to book holidays, and there'll be less supply in the market. So we can increase pricing to match that. And the key here is responsibly raising rates. You want to leverage 2021, but not at the expense of 2022 and onwards. I also encourage you to review your cancellation strategy. So as I mentioned, and as you know, there are pros and cons to all strategies, but I encourage you to make sure that you have one that's working optimally for you and for your guests. Take a look at your minimum stay requirements and make sure they are flexible enough to ensure that your property is being seen by as many potential guests as possible. And last but not least, thank your reservation staff and yourself. This has been a really busy few weeks, and get ready to do the same for your cleaning staff, which might also be yourself in the summertime, because it's going to be a booming summer like we've never seen before. And that's it for today. Thank you so much for listening. As I mentioned, my name is Jess. You can contact us at sales@beyondpricing if you have any questions, or me directly, jess@beyondpricing.com. But yeah, I'd love to hear if anybody now has any questions.
Thanks so much, Jess. That's been really interesting. I think what's really important to recognize is that, as you say, we're probably, hopefully, fingers crossed, facing a really busy summer. And anything we can kind of do to prepare for that right now is really helpful. So seeing those trends is really useful for all of us. And I'm certainly seeing it. Historically, I've been a self-caterer for 18 years. Historically, you would absolutely want a week-long booking in the summer. But from last year's experience, we were getting 2 days, 3 days, 2 days, 2 days, which is exhausting in terms of turnarounds and all of that. But actually, it can mean that your revenue increases quite substantially. So it's more work, and looking at pricing is really important. And as you've just identified, don't over egg your prices, because that could shoot you in the foot. But at the same time, there are huge opportunities here to get it right. So we do have some questions for you. And one of them, this is a really interesting one. My personal experience with, this is not me, this is a question, with dynamic pricing through Airbnb wasn't good. In the area where I operate, the other providers were pricing very low, and as a result, Airbnb would constantly undersell my property. I've experienced that too. I took the decision to set my own prices much higher than the competition, and did very well with the bookings because our accommodation is different in quality and style than the others. Would Beyond Pricing solve this issue?
That is a great question. Yes, there are a couple things to unpack there. Airbnb's smart pricing, even if you don't use Beyond Pricing, I implore you to not use Airbnb smart pricing. Airbnb has two customers. They have you as the host, and then the person looking for a place to stay. And don't forget, Airbnb make the most money when you're fully booked, because they make a percentage of all of the bookings, of the booking fees. So the difference between their approach and our approach is that Beyond Pricing is designed specifically for the guest. So once again, it's not about price gouging and not looking, specifically for the host. So once again, it's not about price gouging and not looking after the guest, but it has the host's best interest in mind by looking at the demand trends, and it will never drive the prices as low as you'll see in a tool like smart pricing. And then with regards to your unique listing, this is exactly where the base price comes in. So I kind of breezed over that in the beginning, but when we were looking at the calendar, we have this starting price. And so let's say Fiona and I own houses next door to each other, and they're identical, except hers has a hot tub. My base price might be £200 and Fiona's will be 220. So we are able, through this base price, to sort of incorporate the unique amenities that make your property unique. And then all of the factors that adjust the pricing that are applied on top of that start from this starting point. So that's how we are able to work with such unique homes. And this is why it's been such a challenge too for the short-term rental industry. In a hotel, you have one bedrooms, or rooms with one bed, rooms with two bed, and you can kind of shift things around if people need to move. But every single vacation rental, every single short-term rental is incredibly unique. And so we need a method that encompasses that. And that's where the base price comes in.
That's really helpful. Here's another one that's kind of associated. I have looked at Beyond Pricing in the past, but I didn't want to give up control. How much control do I have over my prices once I turn it on? And that's kind of a little bit to do with the base price, but there's other elements that you can control, right?
Definitely. So that's a great question too. We're here to help, not to take over control. So we have a minimum price that will never go below, for example. And then you can also set a maximum price if you're worried about going too high in certain periods. And so then what you can do if you want is put these bumpers on, and we'll be able to bump the price up and down in between those based on the demand trends that we're seeing in the market. If you completely disagreed with one of our rates, or if you wanted to hold out for a certain amount for Christmas, for example, you can manually override the rates really easily within the tool to charge whatever you would like to charge. And then we also have this concept of a seasonal minimum. So as I mentioned, you have a minimum price, will never go below, but then you can also say, you know what, for the week of Christmas, I don't want to take any bookings below £800 a night. But for the rest of the year, you're willing to take, you know, something that's a little bit less. So you can set that in the tool and make sure that that the pricing that we push out to the channels is in line with what you expect and what you need to make the most from your property. So you definitely have the ability to have full control, and it's actually really easy. It's a lot easier to adjust rates than a lot of other systems that people are used to using, like some channel managers and property management systems, for example.
There's a good question here. Actually, there are two that kind of run together quite nicely. We are lucky enough to be fully booked until November. Well done, Sue. Is there already a trend of people booking now for next year? And that kind of runs into another question from Rosie saying, does dynamic pricing work when you open your calendars 2 or 3 years ahead of time due to demand?
Yes, great questions. So traditionally and before 2020, we only ever priced 365 days in advance. What we see is that that gives you the best indication of what the demand trends will look like in the market. And you saw in some of the graphs I showed, like some people do book, you know, 2 years in advance, especially if you have a wedding venue, for example. But a lot of people book like in March to stay in March and April. So our philosophy is that you can open your calendars further in advance, but you should be charging a premium for people wanting to book those dates further in advance. Because the other thing that happens is if you get booked today for November next year, anybody searching for a place to stay between now and November next year won't see your property. So in order for somebody to have that privilege of sort of removing your property from the eyes of all other potential guests, we recommend that people charge an increase or increase their prices slightly to accommodate for this. But yes, this is all something you can do in Beyond Pricing. We actually have an increase in place that you can adjust, but we automatically increase rates for by 30% for any reservations that are taken more than 390 days in advance. And this is mainly just a safeguard to make sure that we don't take a booking at a low rate. And you can always adjust the rates or offer a different price, especially if you want to honor a repeat guest and remove the rate from this year to next year, like this summer to next summer, for example. You can do that. That's all within your control. But we want to make sure that, we have safeguards in place that we're not underpricing your listing into the future.
And I suppose that runs into a comment here that Barbara's also fully booked. This is looking good, guys. Look, fully booked for the season. That's a good thing. Or my suspicion is that I've probably left money on the table. That's about right? But this is all about looking beyond today and tomorrow, but actually looking at your future into the future. Is that right?
Exactly. And look, at first glance, perhaps you have left some money on the table, but it's also great to be booked up. And, you know, after the uncertainty of last year, having those bookings and that income in place, I would appreciate that too. And the good thing / bad thing is that if there are cancellations, it'll give you an opportunity to maybe reassess the rates when you open those dates back up. So all is not lost if you're fully booked for summer. You know, you have some great income in the bank, and then potentially cancellations, which were so detrimental to our business in 2020, could actually be an opportunity in 2021. But I love your point, Fiona. Like, we're planning for beyond this summer. Like, we focused on this summer now because that's kind of the most immediate concern. But Exactly. Like, you're going to be running your properties for years to come, hopefully. And so understanding what we saw in the summer of 2021 and preparing for, the summer of 2022 and onwards, I think is key here.
Yeah, and you're absolutely right. We will find that some of our guests cancel because of, whatever the circumstances are, whether where they are, whether they're international or they can't travel. So this is absolutely an opportunity to, once you open those dates back up, kind of revisit your pricing. Absolutely. Jess, we've got a bunch of questions, but what I'm going to do is I'm going to pause there and welcome Scott, and we'll come back for more questions, or as I say, we will publish all of the questions and answers in the next few days, if that's okay. But thank you so much for that, Jess, at the moment.
Yeah, my pleasure.
Scott, we are delighted to be welcoming back. Scott is partner at EQ Accountants, who we are very appreciative have sponsored this session. So thank you very much to EQ Accountants. Scott's going to help break down the Chancellor's recent budget on tax changes. Now, I think probably a lot of people on this call are going to be wanting to know about what potential funding there's going to be in the future. The answer to that at the moment, the quick answer is we're not sure yet, but we're expecting a statement from the First Minister and indeed Kate Forbes later on today. So as and when we find anything out about future funding streams, or indeed ones that are open right now and are having slight difficulties, we'll absolutely publish that as soon as possible. Anyway, going back to Scott. Scott is partner at EQ Accountants and head of EQ Leisure, which is a dedicated team who support a variety of leisure clients, including a lot of self-catering businesses throughout Scotland. Scott, thanks so much for joining us again today.
Thank you for having me, and welcome all. I'll just see if I can share my screen and get my presentation. Hopefully that's clear. So yeah, thank you for that introduction, Fiona, and everyone at the ASSC for arranging today's session. I'm going to talk briefly, fairly strategically, on some of the headline issues and topics that were discussed and approved at the Chancellor's latest budget, slightly later in the year than normal, and it was quite highly anticipated, given the deficit that the country now is finding itself in with all the support provided, and how they would balance the books, as Rishi said. So it will be quite an overview, with nothing hopefully too specific, but as always, I have to take questions, and afterwards, if there's any specific questions out with the time, I'm happy to try and answer them when I can. So what we're looking at is the budget for the 21-22 tax year, which commences on the 5th of April, the 6th of April, and beyond, because a lot of the changes mentioned actually have an impact for the next up to 4 years. So I'll quickly cover off an income tax review. We'll then look at capital gains tax and inheritance tax, followed by VAT, which there's been numerous changes, which for all VAT registered businesses will have been probably struggling to cope with. Corporation tax and capital allowances, there's some quite headline changes there. And what I would do, I thought I'd finish off with having a review of trading structures, and making sure the business is still in the right structure, it's still fit for purpose, and how some of these changes may alter your intention as to how you trade going forward, about how taxes interact with that decision. So looking at income tax, which is set by the Scottish Government, by Holyrood, not Westminster, who came out with their budget ahead of the UK budget. Again, that was a timing issue, if nothing else. And the headline is nothing changed, which was maybe to be expected, given the economy is still in this critical state. They maybe weren't looking to change anything too fundamental, at risk upsetting the recovery which they're envisaging in the second half of this year. So Scottish income tax rates, in terms of the percentages, remain the same. We have to contend with 5 rates versus the rest of the UK's essentially 2 rates. And the only slight change is the increase in the personal allowance to 12,570, where it's been 12,500 for the last few years. And that figure is now fixed for up to 2026. So that is the main change there. And as I say, Scottish income tax, that's what you'll pay if you trade as a sole trade or a partnership or an LLP. Your profits are exposed to income tax. And whilst, I'm going to go back to that slide, whilst it says there the top rate is 46% of, if your earnings are over 150,000, that's not always the case because of other mechanisms within the tax system. And we as tax advisors, I certainly see it myself, we can see effective rates of tax or marginal rates of tax well in excess of 60% in certain what I call pinch points. And it's just to be aware of these because effective tax planning can certainly help avoid landing into these categories. The first main one is if you have income between 50 and 60,000, whilst you're paying 41% income tax, there's also, if you are in receipt of child benefit, which a lot of people are, that gets clawed back and it certainly can see the effective tax rate spike to over 60%. And likewise, when your income exceeds 100,000, for every £2 you exceed it, you lose £1 of your tax-free personal allowance, which adds 20% onto your tax rate. So your income in that band is taxed at between 60 and 63%, depending on your national insurance exposure. So quite high, and you'll never see these tax rates in the headlines because essentially it's via stealth tax, as we would call it. So you just got to be careful and appropriate planning ahead of time to either limit income to these base limits of 50 or 100,000, or looking at other ways to manage that income. So it's important to plan ahead. And as a lot of businesses here, they're diversified. It might not solely be one receipt. There could be employment income, consultancy income, other property type income. So it's really important to plan ahead. As everything with tax, nothing can really be done retrospectively once the tax year is closed. Capital gains tax. This was quite highly speculated to potentially change before the budget was announced. Thankfully, there has been essentially no changes to the rates or the exemptions or the current reliefs, which was very welcomed. However, there has been a raft of consultation papers and documents out there looking to essentially overhaul the system through the Office of Tax Simplification, and our own institutes are very heavily advising on it. As it stands, the annual exemption is 12,300. And again, they've frozen that for essentially the next 5 years. And that is the amount you can crystallise a capital gains tax without paying any tax. But as that's frozen with inflation, that will be worth less and less as the years go by. Capital gains tax rates, which again is the tax you pay when you sell properties, assets that are not potentially your own house, and you sell them for more than you acquired them for, you'll pay a rate of 10 or 20%. And it's the rate depends on the level of your other sources of taxable income. It's quite complicated, and it does interact with your income in any tax year. So it's quite hard to determine at the offset, but those are the two headline rates. Residential property, however, has its own specific rate of 28%, which has been in for a number of years now. So, and that's a residential property gain for houses, but also interest for things like leases and other interest via trusts. So residential property is always going to pay a higher rate of tax, and they've not moved that. But there's been speculation of moving that 10 and 20% rate up to 20% and 40% to align it to the income tax rates. And if that was the case, it'd be interesting to see how the property market and other markets respond. Because what they don't realise is capital gains tax is essentially a voluntary tax. You choose when you want to sell an asset, if you want to sell an asset and pay that tax. There's no stipulation on you to pay it like income tax. So it is a voluntary tax. So if they increase that too much, would they see a lockup and people not willing to sell assets in lifetime to avoid having to pay this what they would view as punitive tax. And I just thought I would remember a change that came in the start of this tax year, that the disposal of any residential property that gives rise to a capital gains tax must be reported in the tax paid within 30 days. That's a massive shift from where the old regime used to be, whereby you'd only have to pay the tax and report it under the normal self-assessment deadlines, which would be 9 months after the tax year end. So it's an acceleration of the tax by up to 20 months. So very important to get that right, and liaise with your advisors if you are looking to sell properties to make sure they have all the information to hand before it's completed. And business asset disposal relief is still available on the reduced £1 million of lifetime gains, and that applies for furnished holiday let businesses that are looking to sell up, and they're taxed at a flat rate of 10% versus the 28% previously mentioned. So it can be very valuable. That's still in existence, but again, there's speculation that that whole relief could disappear. Inheritance tax, similar to capital gains tax, no changes to any headline rates or the nil rate band. Inheritance tax is still charged at 40% on assets above the nil rate band or the residential nil rate band. And again, these have been frozen to 2026. And actually that figure of 325,000 has now been in place for well over a decade by the point. So again, with inflation, it's worth less and less. There was big speculation that business property relief would be reviewed, and that allows for assets used within a business or a business itself to be passed to beneficiaries on death without an exposure to inheritance tax, which can be very valuable. However, the main area of concern was furnished holiday let businesses, and there's been a systematic approach by HMRC to challenge any BPR claim on an FHL business. And it's becoming increasingly more of the view that you will struggle to get a BPR claim. The Revenue are always deeming these to be investments, even with a lot of additional support. However, advisors will still push for those claims, and we'll see how the tax legislation changes over the time. But you do need to carefully consider how businesses are structured to make sure you don't jeopardise an existing trading business through diversification. And we see this a lot in the agricultural sector. We've got a trading farm, but they've diversified into short-term lets, FHLs, renewables. And it's just making sure you always have a full strategic view of that business. And what advisors generally look at are what are known as the Balfour Tests, which were set in case law a number of years ago. And it was looking at a business in the round and asking, is it a trading business? Is it an investment business for BPR purposes? And there's four tests, but I won't go into them here. But generally, there's been a 50% threshold that if you can prove above 50% of the income, the turnover, the profit, assets are used for trading, it would generally be accepted as trading. If you were below that 50% threshold, it would fall to investments. But again, there's been talk of moving that up to 80%. So, increasing the bar to what qualifies as trading. Because if you're not trading, you don't get relief of BPR, and inheritance tax would become payable on the value of those assets. On VAT, I appreciate a lot of smaller end property businesses will not be VAT registered, but certainly a lot what we're seeing are of such size that they have been VAT registered, as the provision of furnished holiday lets and short-term lets are VATable. The temporary reduced rate of 5%, which was introduced last year to help provide support to the sector, has been extended. That was due to end on the 31st of March, but they've put a 6-month extension to the 30th of September, followed by an interim rate of 12.5% for 6 months to March 22. Thereafter, it reverts back to the standard rate of 20%. whilst I'm sure the changes, the reduced rate extensions are welcome, and the rate, it does provide logistical and administrative challenges to businesses, especially after, you know, what Jess was saying there, and Fiona's mentioned, people are booking not just months in advance, but looking to next year already. So businesses have to make sure they are charging the right VAT rate, depending on the money being received or the date of supply, because the date of supply could be vastly different to when the deposits are taken, especially if that's spread over a year. So appropriate advice is essential, but there is also the option to essentially accelerate the VAT point to allow the lower rate to be used, even though the holiday will happen after the rate goes back to 20%. So as a customer, they could get that holiday cheaper if even if the underlying net price remained the same. So it's all about timing and that hopefully cash flow boost. I mentioned briefly the flat rate scheme, which again, a lot of operators are on because there's not a lot of input VAT to reclaim on some of the main costs. If you're providing holiday accommodation, it's been at 0% since last year, and therefore all the VAT that you essentially bring in, you retain. That is set to increase to 5.5% at the same time from the 1st of October, and then reverts back to the standard 10.5% from April. So again, there's opportunities around that, but it's making sure you're charging the right rates in your system, if it's whether it's online or manual, that you are applying the right VAT rates, because if not, it could prove costly when you come to rectify that in due course. Briefly on corporation tax, what we're seeing from our side is more and more businesses are trading via limited companies for a number of reasons, and therefore profits are exposed to corporation tax rates versus income tax rates. And corporation tax is set by Westminster, the UK government, for the whole of the UK. It's not a devolved tax as of stands. The current rate is 19%, which has been the lowest of the G8 and one of the lowest in the EU for a long time, which has been quite an attractive rate of tax, and have got more people into that regime. However, from the 1st of April 23, that rate moves to 25%. Looking back, it has been as high as 28% and over the last 12 years. It's 25% is still, I think, the lowest in the G7. However, profits below 50,000 on an annual basis will still be taxed at the 19% rate going forward, even after 23, and profits in between 50 and 250,000 will be taxed at a marginal rate, anywhere between 19 and 26.5. So there's still the benefit of a lower tax regime for smaller businesses. Profits over 250 will be taxed at the headline rate of 25%. What I want to touch on is, you might have seen out there, is what's been deemed the super deduction in relation to capital allowances. And capital allowances are the tax relief businesses get for qualifying capital spend. And furnished holiday-let businesses are allowed to claim capital allowances, unlike investment property businesses. So this would be replacement of capital items on a year-to-year basis, and can prove quite substantial. They announced this 130% write-off. So for every £1 you spend on qualifying machinery or items, the government will allow you to deduct £1.30 against your taxable profits, which on the face of it sounds really good because you're getting more tax relief than you're spending. However, the flip side is, if you ever sell those assets in due course, whatever you sell them for, you have to uplift the proceeds by a factor of 1.3 or 130%. And therefore, you could find that proceeds being exposed to tax at a higher rate when the rate reverts to up to 25%. So really careful planning is key, because certainly if assets are being acquired and sold within a relatively short period, about 5 years, you may find you pay more tax than you ever saved. So it's just got to be careful planning. And finally, I just thought I would touch on incorporations, because it's something that we've seen quite a lot in the industry, and it's certainly moving, becoming more of the norm, where existing furnished holiday-let businesses are choosing to incorporate, and rather than trade as a partnership of a family partnership or a husband and wife partnership or as a sole trade, they're looking to put that through a company. And not purely for a lower tax reason. There could be succession planning with lots of children looking to get involved, but it's hard to carve up interest in properties. Where if you trade as a company, it's easier to pass shares around family members or whoever else, much easier than interest in properties. So first and foremost, as with everything I maybe mentioned, planning is essential. An incorporation of a business has a lot of interaction between the various taxes that I've mentioned, mainly capital gains tax, land and buildings transaction tax, which is a Scottish equivalent of stamp duty land tax. I say inheritance tax because it can be driven for succession planning, and VAT at the same time. What we'll generally say is if you're looking to do this, you'll need a bit of lead time. If someone came to me now and looking to incorporate before the 31st of March of this year, we couldn't do it. There's too much to consider and it's too big a decision. You generally need anywhere between, say, 6 and 12 months. You could probably do 3 to 6 months. But it'll allow potentially to streamline the business, to get it hopefully future-proof to some extent, and a way of mitigating some taxes at the same time. What we've also seen is because of the recent drop in the Bank of England base rate, debt has become a lot cheaper. And therefore, there's the option to look at refinancing existing debt on FHL businesses and either consolidate that into a one more manageable payment across many properties, or at the same time bring them all together if you've had different lenders on different rates and different terms, to look at bringing that into potentially one lender if the deal can be done. And rates we've seen have dropped a bit. So there's a big advantage there. And again, I thought I'd just mention at the end, when you come to sell a company, if you're looking for an exit route on retirement and there's no succession in place, but you think I'm going to sell this business, if you've got a good FHL company, which contains, I've just said here, 5 properties that are worth £1 million, when you come to sell the company, lock, stock and barrel, the purchaser will pay stamp duty at only 0.5%, where if that was an unincorporated business and the same purchaser came along looking to buy those 5 properties and the other assets, those properties could be exposed to LBTT of anywhere between 0 and 12%. So it can make it more attractive from a purchaser's point of view, and lead to more value being retained by the sellers, so they don't have to discount the sale for that additional tax. That's everything. I appreciate that. That's quite a strategic overview of some of the main headlines, and there's a lot more there that could be said. I'll happily take any questions now, if I can answer.
Thanks, Scott. That's really helpful. It's just incredibly helpful to actually have budgets like that and the kind of intricacies of tax unpicked by somebody that absolutely knows the ins and outs and fine minutiae, because for us mere mortals, it's hard to navigate. We've had a pile of questions.
Hello.
Just to confirm, we will be sharing the slides, and also for all of the questions that haven't been answered today, we'll be compiling a list and publishing those later. So anything that isn't answered today will get answered in due course, just to let you know. But we've had one interesting question. Is the super deduction applicable on buildings, as Gordon understands it's for plant and machinery, whereas in his business, his assets are indeed the buildings?
Yeah, that's a good point. What I should say as well, the super deduction only relates to limited companies. Unincorporated businesses, partnerships or sole trades are not eligible for the super deduction. So it's quite restrictive on that for a start. In answer to the question, no, buildings do not qualify as, or do not qualify as spend that would be applicable to the super deduction. If it's buildings themselves, they will be subject to the structural buildings allowance. However, if there's internal equipment or processes within the building, lighting, heating, electrical systems, water systems, they would qualify for an additional capital allowance of 50%. I never had the chance to go over that. They're deemed to be integral features in buildings, which previously you could only claim 6% a year write-off. For the next 2 years, you're allowed to claim 50% a year write-off, so vastly accelerating the tax relief on internal equipment. However, we still have access to the annual investment allowance of £1 million a year, and that internal fixture spend that I just mentioned would also qualify for AIA. So as you can see, there's the raft of options now. It's very complicated, but the actual structural themselves, a building on that front would not qualify for the super deduction.
Right, can I borrow your brain for maybe a week? It would be super helpful. So on that kind of subject, at what level of profitability should I consider incorporating my FHL business? That's a good question.
Yeah, and you know, it's one we see quite a lot, because there is a level where the added cost and complexity of running via limited company is not really worth the hassle. And generally we would see that as around about £45,000 to £50,000 of profit per individual involved in that business. So if it's a partnership and there's 4 partners and it makes 200,000 a year, 50,000 each, we'd probably see there wouldn't be much additional benefit to doing that. If that same business was a sole trade and they were earning 200,000 a year, then absolutely there's a substantial benefit to be had. So in the round, about £50,000 per individual is a ballpark.
Okay, that's helpful. I'm going to go for one last question. I've heard that if I buy a property directly in a company, it does not have to pay the additional dwelling supplement. I assume that's the LBTT. Is that correct?
Yeah, no, and again, it's a little bit of a misdemeanor out there. The additional dwelling supplement is the 4% surcharge for buying an additional property, unless you're replacing your main residence. So any FHL business that is buying additional properties, whilst they'll potentially pay LBTT, they'll also pay 4% on the purchase price through the additional dwelling supplement. Buying it via company, the company will always pay that tax, even if it's its first property. There's no getting around that. So again, it's a tax to be factored in when you're looking at cash flow pricing. So going via company does not mitigate that tax. In fact, it just guarantees it's always paid. Oh,
brilliant. Of course it does. Right, well, I think we'll wrap up the questions right there. And as I say, there have been a lot of really useful questions, so we will share those with you and Jess. But I'd just like to say thank you so much for both of you to spend the time this morning. And I'm going to hand over to Mel at the moment, but thank you, and thank you all for coming along today. Mel.
Sorry, it would help if I muted and shared my video first. Sorry about that. So I'm just going to share my screen. Oh, where are we? Sorry about this. Right, just to highlight some upcoming events. So we've got our autumn talks, which are really starting to ramp up now over the next few weeks. So we'll be sharing all the details of those. But on Tuesday, the 23rd of March, we've got Visit Scotland, The Road Ahead, How We Navigate the Potholes. That's coming up with Vicky Miller from Visit Scotland to be able to give us some real insights into their vision of how we're going to move into recovery. And then the 30th of March is again Visit Scotland and Green Tourism on responsible tourism. So a couple of interesting sessions there, and we'll be highlighting more sessions going forward, which will also include cleaning protocols and other important information as we start to look hopefully to open soon. But we will be sharing some information from the First Minister hopefully this afternoon when we hear more information there. Also, we've got quite a few people on this session today that aren't members of ASSC, but do give us a call and have a chat, because we can look at converting your membership from what you've paid today for the session. So do give us a call, give Eleanor a call, and we can have a chat with you about that. And also we've got a membership survey which we've got ongoing at the moment, which is just details about membership and how we can help improve things or develop things, make things a bit different. So it'd be great to have your feedback on that. So I think that's about all for the moment. Thanks ever so much to Scott and Jess for joining us. It's been a really interesting session, and we'll provide you with full recording details and also questions and answers in our newsletter in the next few days. But thanks very much everybody for joining us. Take care. Bye.
Thank you.
Thanks all. Bye.